Hello and welcome to House Lux Estate, the channel where we make complex financial concepts simple and understandable. We delve into the depths of finance, from the stock market to real estate, and even your own personal savings. We offer insights that are both engaging and informative, helping you navigate the financial landscape. So if you haven't done so already, do consider subscribing. In today's video, we'll be discussing a topic that affects everyone: inflation and its impact on savings accounts. Our first things first, what exactly is inflation? Inflation, in the simplest terms, is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Central banks attempt to limit inflation and avoid deflation in order to keep the economy running smoothly. Think of it this way: let's say a cup of coffee costs $2 today. If the inflation rate is 2% per year, that same cup of coffee will cost $2.04 next year. Doesn't seem like much, right? But let's fast forward 10 years down the line. That $2 cup of coffee now costs almost $2.20. That's inflation at work. But what causes inflation? There are two main types of inflation: demand pull and cost push. Demand pull inflation occurs when demand for goods and services exceeds their supply. It can be caused by increased consumer spending due to a growing economy, lower interest rates, increased government spending, or more capital investment. On the other hand, cost-push inflation happens when the costs of production increase, causing producers to raise prices to maintain their profit margins. This could be due to rising wages, higher raw material prices, or increased taxes. While inflation is often viewed negatively, a moderate level of inflation is considered normal in a growing economy. Central banks even aim for a certain level of inflation, as it encourages spending and investment, which are key drivers of economic growth. However, high inflation can erode purchasing power. That $2 in your pocket buys less and less as prices rise. This is where it can start to impact your savings. If the money you've set aside doesn't grow at the same rate as inflation, your savings loses purchasing power over time. Now that we understand what inflation is, let's delve into how it affects your savings. So how does inflation impact your savings account? Let's dive into it. When you stash your money away in a savings account, you're essentially loaning your money to the bank. In return, the bank pays you interest. This interest is your return on the investment you've made with the bank. But here's where inflation comes into play. Inflation is like a little gremlin that nibbles away at the purchasing power of your money. Every year, the cost of goods and services tends to rise a bit. This is inflation at work. When the inflation rate is higher than the interest rate you're earning on your savings, you're effectively losing money. Let's paint a picture to illustrate this. Imagine you've saved $100 in your savings account, and your bank is generously offering you an annual interest rate of 2%. After a year, your $100 has grown to $102. But if the rate of inflation for that year was 3%, the cost of goods and services has gone up by $3. So while you now have $102, it can only buy you what $99 could have bought you a year ago. So in real terms, you've lost money. This scenario is not as rare as you might think. In fact, it's quite common, especially in periods of high inflation. This is why it's crucial to consider inflation when you're planning for the future. If you're saving for a long-term goal like retirement and you're not factoring in inflation, you might find that the nest egg you've built up doesn't stretch as far as you'd hoped. Inflation can have a significant impact on your savings, particularly if you're relying on interest from a savings account as a primary source of income. For instance, retirees who rely on interest from their savings to supplement their pension could find their lifestyle squeezed if inflation outpaces the interest they're earning. Inflation can also erode the value of your savings over time. If you save $1,000 today and the inflation rate is 3% per year in 10 years' time, that $1,000 will only have the purchasing power of about $740. That's a significant loss in value, and it's why inflation is often referred to as the silent thief. But don't worry, there are strategies you can use to protect your savings from inflation. And that's what we'll delve into in the next section of our video. So stay tuned for some practical tips on how you can keep that pesky inflation gremlin from eating away at your hard-earned savings. Inflation might seem like a big threat to your savings, but there are ways to protect your money. Let's dive right into it. One of the most effective strategies against inflation is investing. Now, don't panic. Investing isn't as complicated or scary as it may seem. It's basically about putting your money in places where it can grow faster than inflation. One common place to invest is the stock market. Businesses tend to increase their prices during inflation, which often leads to higher profits and increased stock prices. Thus, your investment in stocks can potentially grow at a rate that outpaces inflation. Real estate is another asset class that tends to rise in value over time. The value of properties usually appreciates, and if you're renting out your property, you can adjust rental prices to keep up with inflation. But remember, investing always comes with risks. The value of stocks or real estate can go down as well as up. That's why it's crucial to have a diversified portfolio. This means spreading your investments across different asset classes and even geographical locations to reduce the risk of loss. Now let's talk about Treasury inflation-protected securities, or TIPS. These are government-issued bonds that adjust with inflation. As inflation rises, so does the value of TIPS. This can be a safe way to keep your savings growing at the same pace as inflation. Another strategy is to keep some of your money in a high-yield savings account. While these accounts may not outpace inflation, they can help reduce its impact. Investing in commodities, such as gold, can also be a good hedge against inflation. The value of gold often increases during inflationary periods, providing a safe haven for investors. And finally, consider investing in yourself. Improving your skills or education can lead to higher earning potential, which can help you stay ahead of inflation. Remember, these strategies are not about completely eliminating the impact of inflation, but rather managing it. The key is to be proactive, not reactive. Regularly review your savings and investment strategy to ensure it remains effective in the face of inflation. Keep in mind that while we've discussed several strategies, this is not a one-size-fits-all situation. What works best for you will depend on your personal financial situation, risk tolerance, and long-term financial goals. It's always a good idea to consult with a financial advisor who can provide personalized advice based on your individual circumstances. Inflation can be a daunting concept, but it doesn't have to spell disaster for your savings. With careful planning and strategic investing, you can protect your hard-earned money and possibly even grow it. Remember, the goal isn't to eliminate inflation, but to manage its impact on your savings. Let's quickly recap what we've learned about inflation and savings. We've unpacked the concept of inflation as a consistent upward trend in the prices of goods and services. It's not just about paying more for a cup of coffee or a new pair of shoes. Inflation affects the value of your money and, more importantly, the purchasing power of your savings. We've discovered that if the inflation rate surpasses the interest rate on your savings account, the real value of your savings diminishes over time. Imagine this. You've saved up $100, but due to inflation, the same $100 can't buy you what it could a year ago. That's the impact of inflation on your savings. But not all is gloomy. We've also explored strategies to protect your savings from inflation. Diversifying your portfolio, investing in assets like real estate or stocks, and considering inflation-protected securities are just some of the ways to ensure your savings keep up with or even outpace inflation. Remember, understanding inflation and how it impacts your savings is fundamental to making informed financial decisions. It's not about fearing inflation, rather it's about equipping yourself with the knowledge to navigate it. Thanks for joining us today on House Lux Estate. Don't forget to subscribe so you don't miss our next video where we'll delve into more financial topics that matter to you.